the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Tuesday, the 19th of October, you remember 1987, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. So far, so good. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alix, at the moment, it looks like earnings is trumping inflation, but it's a close battle.
It really is. It's really how strong is demand going to be, and does that outweigh the price increases these companies are dealing with? But it does feel like, all right, earnings, here we go. That's going to dominate the headlines. Procter & Gamble, for me, really interesting. Demand strong, organic sales very strong, but the price input also very strong as well. Abigail Doolittle will take us through some of those results in just a second. So the S&P managing to eke out a gain of 0.3%, but the safety guys like utility and healthcare, they're the ones leading the way. You're still getting a little move higher here. On the 10-year, you have a little bit buying coming on the front end after that huge re-rating we've seen in the last couple days. What's interesting to me, twofold. One, you got the Bloomberg dollar index rolling over 0.4% earlier in this session. That was really helping the overall commodity complex. Also, I want to point out something a little bit idiosyncratic, and that's coal futures price over in China down by about 8%. China apparently is thinking some interventionary measures when it comes to the coal price. That's really interesting, as they can't seem to get a handle on commodity prices as well as those energy prices. So that's really something to watch as we go through today. And we're going to have lots of insight for you on some major market moves and inflation concerns from our guests at the Milken Institute Global Conference over in LA. We're going to be there live, speaking to Scott Meyer at Guggenheim, Mark Jenkins of Carlyle, and Howard Marks of Oak Tree Capital. So don't miss that guy. All-star lineup for you the next 2 hours.
Absolutely. It's going to be fantastic. We're going to get some real insight into what is happening here. As Alix said, the story around earnings, the story around inflation, absolutely front and center, and we've got it all covered here. So we've got Bloomberg's Abigail Doolittle. She's talking about the earnings story today, but we also need to focus on this ProShares Bitcoin ETF. Is it really a Bitcoin ETF, or is it just a futures ETF focused on the price action? Justina Lee is going to look at that. The first futures ETF starts trading. It's a big day. And Joe Matthew looking ahead to where we are with the president's economic agenda. This, of course, ahead of his meeting with House Progressives, which is going to take place a little later on today. So, Alix, let's kick it all off. Let's talk about where we are, how this earnings story is translating into price action in the markets. Abigail Doolittle, over to you.
Well, Guy, it's interesting because we do have that S&P 500 up slightly, but we have lots of laggard stocks that are down on earnings reports in contrast to the banks last week. We do see Philip Morris sneaking ever so slightly higher. But let's start out with that one that Alix was just talking about, Procter & Gamble. Super interesting, down 2%, as Alix was mentioning. Sales very strong, demand very strong, but rising material costs and shipping costs weighing on profits. And in fact, they had to raise their forecast for materials and shipping costs to $2.3 billion, clearly weighing on shares the worst day of the month of October. Now, Philip Morris had been down earlier sharply, and it's interesting because they beat both top and bottom line estimates, but the supply chain issue weighing on Philip Morris as well in the form of semiconductors for their heated cigarette smoking devices. They are going to have a little bit of a shortage, and they had to bring in the profit forecast, but investors looking past that to some degree now. Halliburton, they beat top and bottom line estimates, but that stock is down just a little bit. The CEO there saying that the company is well poised to benefit from the energy crisis. Investors not seeing that today, maybe too far, too fast. And then finally, Bank of New York Mellon, they beat, but the stock is also lower. Let's take a look at this stock, however, Guy, that the last time I looked was up nicely. It was up about, up even more at this point. Johnson & Johnson up 2.2%. This after they put up a very good quarter relative to earnings. Interestingly, they missed sales a little bit, but adjusted earnings very strong. The vaccine forecast held the same, but they did raise the full year profit view. So, Guy, it seems as though Johnson & Johnson, perhaps at least right now, based on what I last saw, less affected by the supply chain issues affecting some other companies out there.
Absolutely. The pharma division absolutely knocking it out of the park. We're going to talk a little bit later, Abigail, to the CFO. I'm really looking forward to this conversation. Such a lot going on with this business, both in terms of its medical devices division, plus also the pharma division. Joe Wolk's going to be joining us. He is the CFO of J&J. Very much, as I say, looking forward to that conversation. I hope you are too. Let's talk about what is happening in Bitcoin land. The first Bitcoin futures ETF has now started trading on the New York Stock Exchange. Here to talk about what the details are, Justina Lee, Bloomberg's markets and quant reporter. Justina, this is a futures ETF. This is important because Grayscale looking to convert their trust into an ETF that basically is based on the underlying. Let's talk a little bit about what we're getting here. How big a step forward is this? How big a day is this for Bitcoin land?
I mean, it really is the day all the Bitcoin bulls have been waiting for. You know, it's Bitcoin's moment going mainstream. And that's because it's expected to lure in a lot of interest from people who maybe previously were not that comfortable buying, crypto directly on the exchanges. And so it's expected to bring in more money. And we're seeing that today with Bitcoin rallying back to record highs, at least, close to the $64,000 mark.
Yeah, it's going to be really interesting to see how it winds up trading, too, and that Grayscale information was great. I love Bitcoin Land, Guy. It makes it sound like the latest Disney attraction. Justina Lee, thanks very much for joining us there. And for more on that debut, we're going to be joined later on by Simeon Hyman, ProShares Global Investment Strategist, for more into that futures contract. All right, in the meantime, in Washington, President Biden and Vice President Harris and Secretary Janet Yellen are all meeting with House progressives this afternoon. This is as Senator Joe Manchin refuses to support the centerpiece of the president's climate agenda, putting the entire infrastructure spending bill at risk. Here with the latest is Bloomberg's Joe Matthew in Washington. Joe, what's the goal of this meeting?
There are going to be two of them, as a matter of fact, two separate sessions, one with moderate members of the House, the other, as Guy mentioned, with progressive members of the House. They'll happen at 2 and 4 p.m. Wall Street time today. And to your point, Alex, the parents will be in the room, both the president, vice president, and the Treasury Secretary, as we have a family meeting here to try to figure out what can be done in less than 2 weeks, an October 31st deadline self-imposed by the Democratic leadership on Capitol Hill. But also important, that is when surface transportation funding runs out. So something needs to be figured out here. And we've learned just in the last 24 hours, as Bloomberg News has reported, that Senator Joe Manchin, of course, the moderate Democrat in the Senate, who's a big reason why none of this has passed yet, is concerned about one of the climate provisions, a clean energy provision inside the proposed reconciliation bill. He says is a non-starter. And so Democrats today are going to be talking about alternatives. If this effort to clean up the power grid doesn't work, is there another way to do it? Maybe a carbon tax is something that we've been hearing a lot about. Or is there a potential for a deal here, potentially for Joe Manchin? Could coal plants, for instance, in West Virginia, maybe get some of the incentives that were laid out for utilities pursuing clean energy as part of that deal? All of that remains uncertain today. And the reason why we're really focused on the climate as well is because on that same day, October 31st, that's when Joe Biden heads to COP26. And he's really hoping to have something, even if only a framework, an agreement to show for it when he gets there, having already called out other member nations for not doing enough. So today's two meetings will be important. The White House, through Press Secretary Jen Psaki, says they are feeling a sense of urgency. There's been an increase in the number of meetings that have been happening, and calling everyone on the carpet today, they hope will generate some form of a deal on infrastructure and reconciliation.
Joe, I tell you what, the British Prime Minister is really hoping that President Biden shows up with something in his pocket as well to that COP meeting. We'll look forward to maybe getting some progress a little later on today. Bloomberg's Joe Matthew, thank you very much indeed. Joe, of course, will be following this story for Bloomberg's Sound On today at 5 p.m. New York time. Talking of the British Prime Minister, Alex, we had an exclusive interview. I say we. Our editor-in-chief, John Micklethwaite, had an exclusive interview with the British Prime Minister, Boris Johnson. The Prime Minister acknowledging within that interview the challenges that lie ahead in terms of the negotiations surrounding those climate talks at COP26.
We need the nationally determined contribution. We need to keep 1.5 alive. We need to restrict the growth in temperatures to 1.5 degrees by the end of the century. We think that with the commitments that we're seeing, we could do it, but we're going to need to see some real action from the participants in Glasgow.
They're managing expectations, Alex, and they're managing expectations down. Bolsonaro's not going, Xi's not going. We don't yet know about India and whether Narendra Modi is going to be showing up. If the President of the United States shows up with nothing in his pocket, this may amount to nothing or something that really doesn't look like it's going to have any meaningful impact.
And I'm really interested to see how the energy crisis that we're all dealing with right now plays out at COP26. I feel like there's going to be two very stern schools there. One is going to be like, we have to accelerate the transition, and the other one's going to be like, no, we can't let go of coal, for example. We definitely need more natural gas. And I feel like it's going to be, it potentially could be much more contentious because of that.
Well, I think you've got two distinct constituencies here, haven't you? You've got the global leadership, which broadly, I think, probably do back climate change and are sort of on board with the idea that things need to move forward here. And then, as you say, with the rising energy costs around the world, you've got another constituency, the constituency that votes for that leadership, which may be souring on this whole idea really quickly. And I think that's going to be something, that sort of dual challenge of not only convincing leadership, but also convincing the populations of these countries that they should be going along with it as well. Massive challenge and getting harder.
Yeah, especially here in the U.S. Liam Denning in Bloomberg Opinion had a really great piece out that just took a look at how bifurcated and how opposed climate change and how you fight it has become in the U.S. and how it's become another like party issue, not a global wealth, health issue. It's going to be really hard, especially if President Biden can't deliver anything to COP26 at the same time.
Basically, Joe Manchin's in charge of this whole process.
Yeah.
As far as I can tell at the moment.
Pretty much. I just can't believe he waited this long to drop the coal bomb, because I kind of feel like anyone could have seen that one coming, considering that he's from West Virginia, but for some reason he waits till right now. Anyway, so that's the COP26 layout as we sort of a drumbeat into that. Coming up on this program, you got fund managers are actually souring on their global growth prospectus, and that's according to Bank of America survey. We love the fund manager survey. We're going to get more on that with Kate Faddis, Grace Capital President and CIO, coming up next. This is Bloomberg.
Central banks are at a place where, for the first time in a very long time, they actually are facing constraints on these policies. It's the first time where they're saying, wait a minute, there are actually constraints on us trying to be as easy as possible, move money to people as much as possible.
The Fed needs to redefine what they think of as an acceptable employment level, or they're going to stay too loose too long.
Anytime the Fed kind of whispers that they're going to tighten, you see the wall of worry increase, and the markets trade off.
The central banks are now running the markets.
The question is whether the economy in the West can function without the central bank being ever present. And I think the answer is we don't know.
They may make a policy mistake here by waiting too long.
So our guests at the Milken Institute Global Conference speaking to Bloomberg Television over the last 24 hours. It's interesting, Alex, to see what is happening with investor behavior on the back of this. Some are convinced that it is still transitory. We are certainly still seeing that narrative being vocalized. But nevertheless, you look at what is happening in the bond market and the sell-off that we're seeing, and that's certainly being backed up with this Bank of America survey too.
I love the fund manager survey. It's such a good snapshot of kind of where we are. So to your point, about 69% of investors still see inflation as transitory, but you have the author sort of highlighting that disconnect between the growth optimism and the allocation to stocks. So investors feeling much more pessimistic, right? Like global profit expectations are now negative. That's the lowest since May of 2020, but yet you're looking at stocks kind of trading right around still those record highs.
Yep. Joining us now to discuss all of this, Kate Faddis, Grace Capital President and CIO. Kate, let's talk about where we are. Last time I spoke to you, you said you've got to stay invested. You can't bail out of this market. You've got to keep both boots in. And that was a conversation about equity markets. You have in some ways been vindicated by the price action since then. We've bounced off the kind of the recent lows. Are you still as comfortable with where we are? The fund manager survey still showing a sort of a clear direction towards equities, but people are getting nervous.
I am still no change. I can't, you have to look at the fundamentals. You can't look at the tape and get scared or get excited. What has really changed? Interest rates are still zero. Where are you going to put your money? We have baby boomers that are retiring. We have 401ks that need a place to go. They're going into equities. I don't see anything changing.
What about on an idiosyncratic basis? I feel like sector by sector, we're hearing more supply chain concerns, right? Like we did the semi thing, and that's still an issue. But now, like Procter & Gamble, I mean, their organic sales were good, but they're getting hit on so many input fronts.
No question. No question. The supply chain is a huge issue. And I think it's going to prove to be a multi-year issue. You've got things held at the port, and then you have people moving from China to Vietnam, from China to Mexico, staying domestic. I think this is a big secular shift, but I still don't think there's anywhere to go with this wall of cash. Increasingly, the wall of cash is also being invested passively. So it's just unstoppable.
So if you are selling bonds, what would you do with that money? Would that money go into cash or would that money go into equities? Would you be upping your allocation towards equities at this point?
I would be upping my allocation to equities. I would be upping my allocation to equities. To sit in cash, waiting for what? Who's to say when this is going to change? And let's say it does change. Bear markets don't last very long. Bull markets are enduring. I would stick with equities.
Where?
Great question. Great question. Energy looks interesting here. Energy looks very attractive here. Absolutely tech. I keep talking about the Silicon Valley tax that we all have to pay. You have to stay in tech. I would still stay away from staples. I think staples are tough. I think materials are tough. REITs produce income. I would stick with REITs. Industrials, for me, are also tough. They face all the headwinds, the problems with the supply chain, all the problems. I'd stay away from industrials.
Talk to me about rate sensitivity, because it does look as if, back to the bond conversation, that yields might be continuing to climb higher. Walk me through the arguments about all those areas that you just laid out and overlay 50 basis points worth of additional yield on top of the 10-year and how that would impact those areas.
The rate conversation, Guy, is very different today than it was 10 or 15 years ago. 10 or 15 years ago, rates meant something. Today, the marginal buyer and seller of marginal person controlling the rates, the Bank of Japan, the European Central Bank, the Fed. So for me, I don't read any information from what's going on in rates. The Fed could simply decide to buy more and boom, you see the opposite thing happening. So I think a lot of the rate talk is noise.
Which is such a great point, because then it's made treasuries a really ineffective way to hedge. I mean, sometimes 60-40 portfolios work, and a lot of times it's not. We are seeing increased volatility, though. Where do you go to hide out in that?
I would hide out in equities. I just don't think there's any alternative. You can you go into bonds and wait for what? What tells you now is the time to go back into equities? It's very, very hard to do. So I think strategically you have your asset allocation and you stick with it. And it's not easy to do, but I say you stick with it. And until I see something that tells me there's a fundamental shift, this is what I'm doing.
Yeah, and that's exactly the point, where we're seeing sort of sentiment versus the actual underlying equity market. They are diverging, and that's a great case for why. Hey, Kate, good to catch up. Kate Faddis, Grace Capital President and CIO. Thank you very much. All right, guys, stick around. Coming back, we're going to go back to the Milken Institute Global Conference. We're going to hear from Scott Minerd, a Guggenheim CIO, next. This is Bloomberg. From New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. It is day 2 of the Milken Institute Global Conference underway in Los Angeles. This year's gatherings focus on disruptions and innovations brought on by the pandemic. Bloomberg's Caroline Hyde is now there with Scott Minerd, Guggenheim CIO. Caroline?
Alix, thank you so much. And of course, many will know Scott Minerd, $250 billion of assets under management, one of the main forces and focuses in asset management right now. What they might not know about him is he's recovering from COVID right now, long COVID. Scott, it is so good to have you here. And this is tough on your immune system right
Oh, it's very hard. First off, I've now inherited the James Earl Jones voice, so I'll be doing voiceovers from on. It's really interesting, Caroline. I didn't know this, but if you've had the vaccination, the COVID symptoms are not the same as if you didn't. And so I had virtually no symptoms, but I just started getting very, very tired. So I finally just decided to have a COVID test. I found out I had it. And, from that time on, I've been suffering with almost a chronic fatigue syndrome. I mean, it's getting better slowly, but almost everybody I've discovered that gets this in a vaccinated state ends up with this long period of fatigue. And in the worst case, it can last for a year. I think I'm doing better than that, but thank you for asking.
Well, thank you for bringing your resources, your energy, when I'm sure it's particularly hard at the moment. And we're in a time where COVID is still, overreaching our economy. People are still suffering, such as yourself. And we're, though, living in this remarkable situation where valuations are extraordinarily high and we're in a perfect storm to do with inflation, supply chains. Is anything out there of good value right now?
I don't think there's value to be found anywhere that I can identify. I mean, Shiba coin, which was at $1,000 back in the first quarter, is now at, if you put $1,000 in, then it's worth 2.1 million today. I mean, it's pretty impressive, but I'm not even sure I would have called Shiba coin a value back in the first quarter. I definitely wouldn't have. But, I think this is the case of a bull market. The thing that's different about this one is in other bull markets, you could always find these sort of isolated pockets or other sectors to go to that were cheap. Yeah. So you could diversify and get rid of risk. Everything here is so highly correlated based upon all the global liquidity from the central banks that I mean, I'm not going to say that, we're in imminent danger of a collapse in prices, but it is a case where, they say bull markets are when things are expensive and they get more expensive, and I think that's the world we're in. Not a world I'm terribly comfortable in. Mm-hmm. I'm more value-oriented, but you just sort of have to go with it and try to be as prudent as possible.
Be comfortable with being uncomfortable. And even at the time where the IMF a week or so ago was warning that as we see a stimulus, we're not even withdrawing stimulus, we're just slowing it down, that we could see volatility, we could see a significant sell-off in risk assets. You don't think that's a risk?
I don't think right now it is. The seasonals, I had written a piece about 3 months ago, how I was concerned about the resurgence of COVID and the Delta variant, and that we could get a pullback in risk assets. I think we've had it. I think last week the surge we got in equities marked the bottom. Seasonally, stocks do very well between here and May. And it's really interesting because I think it's also spilling over into other asset classes like crypto. Yeah. So, you see Bitcoin and what it's done over the last few weeks. I can't tell you it's a value, but I won't tell you that you should short it because it's likely to be higher in the coming months.
Would you go into the Bitcoin futures ETF? Would you think that was, or would you want to go long Bitcoin in and of itself?
Well, I mean, Bitcoin in and of itself is very difficult. Like for us, we've invested in Bitcoin for our clients, but you end up you have to be in something that's a tradable vehicle like an ETF. So I think the ETF is a very interesting development, especially for, institutional and individual investors who don't know how to, how do you buy a Bitcoin? How do you set up a wallet? How do you safe keep your Bitcoin? Because if you just leave your Bitcoin in your wallet, it can be stolen. So you have to go safe keep it somewhere. And so there are companies that do that, but that's really complicated. Our biggest issue was how would we clear it? And State Street didn't clear it. Nobody cleared it. It's a normal clearing, so we ended up having to buy it through a closed-end fund. But now an ETF would even be a better form of it.
400,000, I remember that number when he came on once and said, I see it going to that. Do you still see that this wall of money, the fundamentals which were in place at the moment, will drive assets such as crypto to that sort of level?
I think so, yes. I mean, ultimately people say to me, why are you so bullish on crypto? And I'm not, I got to tell you, I think 70% of the coins out there today are garbage and will go away. The question is, just like the internet bubble, which of the companies survive? Will Amazon be the big winner, or will Pets.com be the big winner, right? Of course, if you're old enough like me, you remember Pets.com failed, and Amazon was a bookseller that changed the world.
What price did you buy an Amazon at originally?
Around $9, and I was a genius. It went to 14, and I sold it 6 months later. I'm an investment genius. But so how do you know which of these coins is it? But one of the things people forget about money is a social good. They think money is something that governments create. No, money is something that society creates. And for instance, if you were in a prisoner of war camp in the Second World War, the common currency of money in the prison camps was cigarettes, right? So people create this, and that's what, when I saw Bitcoin back when it was $100 and I didn't buy it, I was fascinated because to me, this virtual currency world is the future. And now the question in my mind is, the central banks obviously see it as a threat. So, what are they going to do around regulation? What competitive currency are they going to develop, like the Chinese with the virtual RMB? The Federal Reserve is studying it. The central banks just can't sit by and watch this go on and out. So, to play out without their involvement. So I think we're in a period here where we're going to have a shakeout, but will the shakeout come before we get to 400,000? Mm-hmm. Not. I mean, look. I'll tell you right now. I would say that if you want to be long cryptocurrency, probably now is not a bad time to get long. But we bought in around 20,000. It went to 50. I made a comment that I thought we could do a 50% correction. We sold. As I tell people, the line from Baron von Rothschild, when asked what was the secret of his great wealth, he sold. I sold early. We made money. The pullback came. We didn't reinvest because I thought we could potentially get much lower, and we still might, but I don't see it happening right now.
Is there anywhere that's cheap?
No.
Is there anything that's uninvestable? For example, is China uninvestable?
I think China is uninvestable. The Republic of China just is doing a bond issue this morning.
You're not a buyer?
No. 30 years at 2.6%. I mean, if you want to tie your money up with China for the next 30 years for 2.6%, then I encourage you to get out there and do it and lock it in while you can. But there might be some bumps along the way in the next 30 years.
Scott, I could talk to you for so much longer. Sadly, our time is up, but we wish you well. We wish your immune system well. And thank you for bringing up the energy and giving us always such insight. Scott Minerd, Guggenheim CIO. Cool $250 billion of assets under management, of course, Guy.
Yep. He's got a lot of thinking to do about what comes next, doesn't he? It's interesting what he has to say about kind of the here and now. Scott Minerd, the Guggenheim CIO, Bloomberg's Caroline Hyde. Thank you very much indeed. Alex, I thought it was fascinating. So he talked about the recent low. He says that he thinks actually at the moment we don't look at risk as of a significant sell-off. This obviously Tuesday, the 19th of October, 1987 was Black Monday. No repeat of that he sees in the near term.
Yeah, I also, really great stuff when it comes to crypto, particularly the Bitcoin futures ETF that just started trading, and how for institutional players this is actually a pretty good idea because it's hard to trade, say, the physical asset, if I can say physical asset. That was really interesting as well. He also said that 70% of crypto coins are garbage and go away. That was kind of fun.
Yeah, which 70% is the bit that
exactly.
I want to know. But yeah, I guess what they're creating here, ProShares, is effectively a bet on price action. This is about price action rather than owning the underlying.
Yes.
And that, I think, is going to be the interesting difference between what ProShares are doing and what Grayscale are doing. Yeah,
100%. And you can see like different types of gold ETFs, for example, doing something similar, and sort of the different types of investors in that and how you hedge it. All right, let's get back to the market here. You got J&J really popping now. You got up about 2.5%, reporting a really solid quarter, boosting its 2021 profit forecast. Joining us now for more, Joe Wolk, Johnson & Johnson Executive Vice President and CFO. Joe, so good to see you. Thank you so much for joining us.
Hi, Alex.
Hi, it was a great quarter. Pharma, again, really great, up 13%, 11% so far year to date. It's hard for other peers to really match that. How long can that go on for, and what products are going to be like the next catalyst to keep that kind of growth rate?
Yeah, Alex, we think it can go on for a very long period of time. We're certainly pleased with our core products and the performance of Stelara, Tremfya, Erleada, and Darzalex in immunology and oncology, respectively. We'll have the opportunity to speak with investors on November 18th and showcase some of our pharmaceutical leadership, but more importantly, the pipeline that we've been investing in nipocalimab for autoimmune diseases. We have a CAR T for multiple myeloma that has a PDUFA date this quarter. So we're very excited about the future. We think it can go on for quite some time. And that above market performance, I'll remind you too, is also despite price decreases of about 5%. So the team's just doing a fantastic job. We continue to elevate the level of investment in R&D. This year, through 9 months, we're 23% ahead of last year's record-setting year in terms of R&D investment. So we're positioning ourselves, while meeting short-term expectations, we're positioning ourselves very well for really the remainder of this decade.
Joe, good morning. It's Guy in London. Guy. To carry on with what Alex has been talking about, you get a gold star for the amount of tax that this company has paid this quarter. Any CFO is going to be proud of the kind of reduction that you've managed to generate. Again, that is something that may or may not be sustainable. How sustainable do you think it is?
In terms of the tax, that was heavily influenced by, I would say, one-time favorable adjustments. So, Guy, as we file our returns for 2020 in the third quarter, there's some legislation that was maybe clarified from really regulation across the globe. All those kind of seem to fall in our favor. I would never get too caught up in one quarterly tax rate. I appreciate the gold star, but I would look more towards the full year outlook where we're around 16%.
I guess to piggyback, are you expecting at some point, though, higher taxes, either the global minimum tax or maybe coming from D.C.?
We continue to monitor that, Alex. I think it was very interesting in some of the data that just came out in the last few days where despite lower rates, the government actually took in its highest level of tax receipts. So when you think about tax policy, you certainly want to create jobs. You want to create growth. You want to make your companies that are based in the U.S. competitive. I would say the lower tax rates have certainly served us in that capacity. I mentioned the R&D investment that we're able to make to fortify the long term. At the time the TCJA of 2017 was passed, we committed to investing more in the U.S., about 20% more of the subsequent 4 years. That was better than $30 billion, and I'm happy to report we're well ahead of that number. That's translated into certainly a healthy business, but also about 3,000 to 4,000 more jobs in the U.S. at Johnson & Johnson. So we think the current tax policy works extremely well. And when you balance that with some of the government data that just came out in terms of the record receipts that are being received, we would see no reason to change at this point.
Joe, as you mentioned a moment ago, knocking it out of the park when it comes to the pharma business. Do you think, and you ran through how you think this is going to be sustainable, but you've got, circa 31 billion sitting in cash and marketable securities right now. Yeah. My question to you is, how are you going to use that money? And do you think that pipeline needs augmenting?
We're always looking to augment our pipeline, Guy, and it's not just in pharmaceuticals, but in med device and consumer. What we do is we look for a strategic fit, and we define that by either having a scientific expertise or a commercial capability that complements or logically expands the platforms that we know so well. And then we have another test, and that's the financial component. Are we not only covering the cost of capital, but also, I would say, a risk-adjusted factor for the risk that we're bearing on behalf of shareholders, making sure that we cover that. We're looking, our executive committee meets with the segment heads just about every month on opportunities, or on really as a need to basis with respect to looking at external opportunities. And about 50% of our growth over the last 2 decades has come through inorganic means. So we'll continue to do that, plugging in the right spots. And we've got a great, I'd say, ecosystem of innovation with our J-Labs facilities, as well as our Johnson & Johnson Development Corp, where we place equity.
Yeah. Hey, Joe, we can't let you go without talking about the COVID vaccine, obviously. Sure. A couple questions on it. How soon do you think that boosters can be available in the U.S.? And now with this potential to mix and match vaccines, do you think you can really have the same kind of take-up as we saw in the beginning?
Yeah, so Alex, we'll let the science play out here. The FDA approval is likely in short order based on some of the comments that are out there, but we'll respect the scientific process. In terms of supply, we should be able to meet with our 9 manufacturing facilities producing COVID-19 vaccine across the globe. We should be able to meet whatever demand is out there. We'll continue to watch the situation. I do encourage investors, though, and I did this on the analyst call just this morning, that the vaccine for Johnson & Johnson really presents only upside. The strength of our business, the growth that you've seen this quarter across all 3 units is really the story of not just last year, but this year as well, and I think it's going to be the story of the future. We're certainly proud of the contributions we made to end the pandemic with respect to our vaccine, but investors shouldn't get overly giddy or overly pessimistic with respect to vaccine news.
Joe, stock's up 2.5%. You're obviously doing something right this morning. Joe Wolk, Johnson & Johnson, Executive Vice President and CFO. Thank you very much indeed. Coming up, we'll carry on the COVID conversation, COVID's impact on the credit markets. Mark Jenkins, Carlyle's head of global credit, joining us next from the Milken Institute Global Conference. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, and you're looking at a live shot of the principal room. Coming up, an exclusive interview with Ed Bastian, Delta Airlines CEO. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
So 42 minutes past the hour. COVID reshaping the way that the credit investors do business. Bloomberg's Caroline Hyde is at the Milken Institute's Global Conference with one of the top voices in the field, Mark Jenkins, Carlyle's head of global credit. Caroline, over to you.
He is indeed, Guy, one of the top voices, and it is great to have your voice on the show, Mark. And talk to us. We're just saying how COVID has reshaped the world of credit investing. How has it? I mean, is there, like we keep hearing, this wall of cash, desperate to find a home? Is everything very overvalued?
Yeah, well, there's 2 questions there. One is there's a wall of cash. I think, look, generally in alternatives, there has been an increase in growth of that area over the past 10, 15 years. In private credit in particular, the market has moved from roughly $300 billion in 2008, 2009 to over $1 trillion today. So there's been 10 to 12% growth. But when you put that on the backdrop of what overall equity and bonds are in the public market, which is like 200 trillion. I mean, it pales in comparison. And I think there's been a number of things that have driven that over the past several years, which is one, we're a lower rate environment, have been in a lower rate environment for quite some time. And people are rotating out of fixed income into private credit to pick up that yield in their portfolios. We've also seen more public companies go private and stay private longer. So there's twice as many private companies owned by private equity today than there are public companies, and so they're looking for private capital. And then finally, the banks over the past decade have really been retrenching from the leverage lending aspect of the markets. So, private capital has come in to fill that void, if you will.
But has it driven valuations too lofty? Are things, quote unquote, too risky when you have, as you say, more private opportunities and more money going into it trying to seek yield?
Yeah, I think that there's 2 components. One is valuations, we would say, across all asset classes today, they're high, right? And we're seeing that in the equity markets in particular. That's a good thing for us from a credit perspective.
Why?
Because it gives us a bigger margin of safety, a bigger cushion, if you will, for the lending that we're doing. So if you actually looked at pre and post-pandemic, equity cushion has actually increased materially since 2019. So that's a good thing. Secondly, cash flows are up for corporates. Cash flow coverage is up, leverage is up on an EBITDA basis, but the coverage ratios are up tremendously because of the growth you've seen on the top line and the bottom line over the past 12 months or so. Okay. So I think from that perspective, we feel pretty good. If you look at what I really look at and what investors are looking at is what is that spread between the public market alternative and the private? And that has stayed relatively stable to increased over the past 12 to 18 months. And depending on what asset class you're looking at, but take direct lending, it's been roughly 120 to 130 basis points of pickup from going from a public alternative into a private alternative. So I think the value is still there for investors.
And of course, you're long-term investors to a large extent. Do you look through cycles? I mean, does it matter to you whether everyone's now thinking the Federal Reserve is going to tap on the brakes?
Yeah, I think it's, look, interest rates are relevant, I guess, in terms of what is that going to do to valuation, most importantly, and we all know that. So we look at that, but I think there's two things to consider. One is the majority of our products are floating rates, so they're basically short duration. So as rates go up, as long as you're in good companies with good credits, then you're benefiting from that. Number two is that we are, people, our investors are looking for us to invest through cycles, not at points in time in the cycle.
They're not buying the dip.
They're not buying the dip. I mean, we do have some strategies that do that, obviously, and we're able to pivot on our platform to do that. But by and large, I mean, people are looking for steady, persistent returns through cycles. And that's what we're supposed to deliver, right? So it's the expectation of what do you have in your policy portfolio as an overall investor, because we're just one component of a very large portfolio for many of our investors.
Those portfolios of investors are now becoming more attuned to, well, where they want to put money from a moral perspective, from a aligning with their value perspective, ESG, dare we say it, environmental, social governance. Is there enough transparency in this space? Are you able to measure the impact that some of your offerings have?
Yeah, I think it's like I say with the hybrid work environment. Like, what does that mean? Can you explain what that means?
What does it mean to you?
It means, for me, it means 3 days a week in the office, 2 days working somewhere else, and we stuck to that. But I think generally, it comes down to measurement and standardization. And as you noted, I think in some of your prior sessions that we basically teamed up with CalPERS to have a convergence of data on ESG and how that's measured across private asset portfolios. And that's just one way we as a firm are trying to drive that forward. But I think from a firm perspective, what we said is ESG has to permeate all of our investments, all of our portfolio companies on the private equity side, all of our credit investments. And in credit in particular, what we did is we came up with a ESG risk framework using SASB, which is the Sustainability Accounting Standards Board framework, to help us measure and identify risk in our portfolio and put a risk rating on it so that we as portfolio managers can identify the risk going in and what we hold in our portfolio. And importantly, we've just recently raised a $2 billion credit facility for global credit that is tied to those metrics. And so in fact, if we're performing well, then that will lower the cost of that leverage line that we're using on behalf of our investors. So it's a real way to demonstrate the power of ESG.
And incentivizing it.
Incentivizing as well, absolutely.
Mark, can speak to you for so much longer. Mark Jenkins, Carlyle, Head of Global Credit. Alix, to you.
Thanks so much, Caroline. Really appreciate it. Mark Jenkins, Carlyle Global Head of Credit. That was a good conversation. Lots of fun. All right, coming up, you got, after years of delays and setbacks, we're talking like 7+ years, the first Bitcoin-linked ETF in the U.S. is finally trading. We got the ProShares Bitcoin Strategy ETF. Started trading about an hour ago. We'll talk to Simeon Hyman, the company's global investment strategist, will be joining us next. This is Bloomberg.
Bitcoin in and of itself is very difficult. Like for us, we've invested in Bitcoin for our clients, but you end up you have to be in something that's a tradable vehicle like an ETF. So I think the ETF is a very interesting development.
That was Guggenheim's Scott Meinert speaking to us moments ago and talking about the fact that ProShares Bitcoin Strategy ETF, which is the first Bitcoin-linked exchange-traded fund, it tracks futures, started trading in the U.S. Here with us now is Simeon Hyman, ProShares Global Investment Strategist. This is a big day. It's been long in coming. What kind of take-up do you expect?
Look, we're really excited to bring BITO, the first Bitcoin-linked ETF, to investors as an important opportunity for them conveniently to invest in Bitcoin in their regular brokerage account. And it's with belt and suspenders, if you will, in the regulated futures market and in a plain old ETF wrapper. So we think this is going to allow many people who've been waiting for an easy way to do this and a robust way to do this to now be involved and have it in their portfolios.
Simeon, do you think the average investor is going to understand the difference between a cash-settled futures ETF and a ETF based on the underlying, i.e. this is going to come with roll costs? Do you think the average investor, the investor that you're talking about, is this the right product for them?
Well, we want them to understand because, in fact, we think there are some key advantages. There have been several, and in fact, a growing group of experts who have been writing that the futures market is one of the best places for price discovery in Bitcoin. You see this in other asset classes. As an example, in credit default swaps, reflect price more quickly than cash bonds. So to some extent, it's a feature, not a bug. And there's tremendous volume here too as well. The CME futures market trades 40% more volume than the largest US Bitcoin exchange. So it's not a second order choice. We think it's quite a robust one.
Some ETFs that track futures have gotten into some trouble, particularly when you have to roll over some of the futures contracts, et cetera, because there's a lot of selling on the front month. Did you guys structure it in any way that kind of helps that issue?
So we are focused on the front month because that has historically had very good tracking to spot Bitcoin, high beta, high correlation. To give you contextualize it, in the month of September, the average difference between the near month and the next month contracts on any given day was about 20 basis points. That would annualize to about 2.5%, which we think compares really favorable to lots of other ways you would get exposure. We run a mutual fund, BTCFX, running the futures-based approach to Bitcoin that we launched in July. And through last Friday, as an example, the Bitcoin reference rate that amalgamates a few exchange prices was up 51%. Our mutual fund running the futures strategy was up 52. GBTC, the Graysale Trust, was up 37 in that period. So we really do think this is a first-class way to have exposure to Bitcoin in addition to being a convenient way.
Do you think most people that use it, though, are going to be using it for price action, i.e. they're traders rather than investors? Because a lot of people are certainly buying Bitcoin for trading purposes. They like the volatility, they like the price action. You are building here a perfect vehicle for them. Why do they need Bitcoin when they've got you? And if they got you, is there a danger that the underlying actually becomes affected negatively as a result of that?
A couple of key points here to make. This will absolutely be a vehicle that will be attracted to both, we think, folks who will use it longer term in their portfolio, but also to the trading community. But this, again, is a really important and valuable feature of the ETF market. If you think about this, you buy and hold this for whatever it may be, 3, 6, 9, 12, 24, 36 months. One day, you need to monetize it. You're going to be really happy that there are traders involved in the space too to make sure that the trading is really efficient. So we think this is a landmark in the broader Bitcoin ecosystem that's going to bring even more liquidity to the marketplace in the evolution and maturation of it.
Simeon, it's been a long time coming. It's a huge day. Thank you very much indeed for taking some time to speak with us today. We really appreciate it. Simeon Hyman, ProShares Global Investment Strategist. Greatly appreciated. Alex, we're just about wrapped up for this hour. Up next, an exclusive interview with the UK Prime Minister Boris Johnson. He sat down with our editor-in-chief, John Micklethwaite. Really looking forward to kind of digging into the details of that with John.
Yep, it should be really interesting. I really want to hear what he said about the energy crisis and what that means headed into COP26. A lot of diverging views. Could you get to consensus there? This is Bloomberg.